Hey folks, it's Rob Flax here with another Sunday session, and today is a very special session. It's called Over the Horizon, and this is an event that I do every 6 months or so to actually help you to understand where I think the market is actually going. Now, I want to be very, very clear. I'm not a property economist or anything like that. So what I'm going to show you is really my research and my thinking into where I think it's actually going. You need to do your own research and your own thinking. Now, a lot of the things that I'm going to cover here, we actually covered in an event about a week ago called Developer Launchpad, which was a 2-day event where I went into about 14 hours worth of content that took about 200 hours to research, to look at all the different things that are actually happening, I guess, in the market. And what this is a small extract out of that event where I show you the 16 different drivers and market forces that are the things that move the market. Now, there are lots of things that we see from a rhetoric in the media and that sort of thing with regards to things that are happening. So, for example, right now, interest rates have just gone up and inflation's high, government spending's up, and a whole bunch of things like that. What this is why those things are happening, and more importantly, why I think that's a good thing for you and not a bad thing. See, so not everything that you're going to hear in the media is actually a negative. Sometimes, as property developers, we need to be counter-cyclical. We need to understand that some of these things are motivating and, activating us. So all that government spending, for example, you're about to see, that is all enabling where is our property market going. So the government spending setting up the opportunity for us to solve the challenge with the 1.2 million houses that we're short at the moment. And we're needing an audience of you guys, the small scale developer out there, to actually be the army to actually build this stuff. So understand that you can actually do that. Now, if you're brand spanking new to property development, you're not sure if this is for you, then hopefully this will give you some motivation and inspiration in order to do that. So just a couple of little tidbits on how you can actually start to get involved. So we have meetup events that run all the way around the country: Brisbane, Sydney, Melbourne, Adelaide, and now Perth. Okay, we've announced that we're going live in Perth in the not too distant future. So we run 55 events a year where you can actually network with and stay engaged with people that are actually doing developments right now. So real people doing real deals all the time, every single day. So we run 55 of these events a year. Very worthwhile. Industry experts, town planners, civil engineers, architects, accountants, property lawyers, they're all trying to give you insights into how to do this property development game. And then we have members of our community sharing real deals. So you get to see the good, the bad, and the ugly of a project, what they thought they were going to make, what they actually made, how they assessed this site initially, what issues and challenges turned up that they may not have recognized. So you can actually learn from the successes of other people and actually go and actually do that. Now, if that motivates and inspires you, we also have a free course, the 7-step formula to financial freedom, which is going to give you the insights into what it actually takes to be a property developer. And if you are still at that point in time wanting to know what to do, then we have our formal education and mentoring program that's going to give you the insights into how to actually start from absolutely nothing and build a scalable business using all the things that I'm about to touch to you on, understanding why these drivers are actually going to move us. So without further ado, folks, let's go into, the extract from last weekend's event. It is where I think the market is going and why all the negative media rhetoric that you're hearing at the moment, why that's actually a good thing for you if you are thinking about being a property developer. And if you're an investor, there might be some challenges ahead, but if you're a developer, mate, this is going to go to the moon, is my kind of prediction. And I can't wait to see some of you guys come and join me on that journey. So let's go inside, take a look.
Let's see what the different property commentators and that sort of thing are saying around the grounds. So firstly, from reading the tea leaves of the property market, there is a difference between an indicator and a driver, okay? Now, property indicator is what traditional investors are using, and a lot of you have said that you're traditional investors, okay? So an indicator measures what has already happened, okay? Whereas a market driver is what you use to predict what is going to happen next. So one is, I guess, correlation, and one is causation. Okay, so when we're looking at what's already happened, okay, market indicators, that's what property commentators are going to comment on. So because they don't want to be, I guess, getting themselves in trouble and predicting where the future is, so they comment on what's actually happened, right? And then the media picks up on that, and then the public then starts to respond to the media hype. But all of that is telling us things that actually happened with a sentiment that may have been a decision point that happened 6 months ago. Now, let me explain what I mean by that. So if a sale price gets recorded today, then several months ago, somebody had to think about, hey, I want to sell. Then they had to go and approach a whole bunch of agents, determine which agent was the best one. They needed to prepare the property for market, put a market campaign together, potentially go to auction, maybe not, then go through a settlement process. Then the transaction is then actually recorded on the sale prices. Okay, and so that's what the commentators are reporting on, is when it actually hits the titles office. But the sentiment, the decision was actually 6 months prior. So when we're looking at indicators, and there's a lot of them out there, we're looking at the past, okay? So there's a lot of these indicators. So there's listing volume, sales volume, stock on market, there's vacancy rates, rental rates, days on market, auction clearance rates, vendor discount rates, consumer confidence, and business confidence. Every single one of them has already happened, okay? Now, when we're seeing that, that means there's a lag in that information, and that is super important to know. Now, there's a lot of metrics to go into this, and I'm gonna simplify this out the wazoo, and I'm going to borrow the I guess the teachings of a gentleman called John Lindemann, and he's got a great article where he actually tells you how using just 2 indicators can give you a fairly good read on the current market. Okay, so what he's saying is, if you look at sales volumes and listing volumes, those 2 indicators by themselves, depending upon what direction they're actually going, will tell you whether the market is confident, concerned, crashing, or booming. Now, if they're both going up, so as listings go on, the sales are actually occurring, then the market is confident and things are quite buoyant. Okay, if they're going the opposite way, then clearly the market is concerned. But it's the crisscross where it gets really, really interesting, okay? So if the listings are going up, that means everyone wants to sell, but the sales are going down. That means there's nobody buying the stock, and more stock hits the market, which means that people start to get desperate. And when one person sells at a discount because they get desperate, it means that the next person has to sell below that in order to get their sale, and that causes the market to crash. When it goes the opposite direction, where there's hardly any listings going on, but as soon as it goes on, it sells almost instantly, that is people seeing the market booming and they're holding on because they want to sell at the top of the market, not at the bottom of the market. So they are not selling their property yet because they're waiting to try and pick the peak. Okay, so when we start to see just those 2 indicators, that gives you a fairly good insight. Now, it's not 1,000% accurate, but it's a very, very good litmus test. Okay, so if we look at, I guess, Cotality, used to be called Core Logic, and they have a monthly chart pack that they release. You can see in this green box here, you can actually see that for the majority of states, the listings are down. Okay. Melbourne and Canberra are the only ones where the listings are up at this moment in time. If we then look at the sales volumes, then the sales volumes are up predominantly, and there's a couple of places that are down. So Perth is down, Brisbane are down, but they're not down by much. And then places like Sydney and Adelaide are kind of on the cusp, and you kind of, they could be read one way or the other. Okay, so when we kind of correlate all that together, then this is kind of what the verdict is with the market stating at the moment. So Brisbane is saying that it's concerned, but it's on a cusp because it's right at the point where those things are starting to shift. Equally, Sydney is saying the same, and that's largely because people are worried about interest rates and a couple of things like that. But we've got Melbourne is confident, Adelaide is booming, Perth is currently concerned as well. But again, it's on the cusp. Now, Perth has gone through, a boom of sorts already, but I think it's going to be coming back to another boom very, very soon. So then that is reflective when you actually start to look at the average dwelling values pretty much everywhere. The market has gone up. That's fairly consistent everywhere. So we're seeing prices go up and we're going, hey, it might be too late to actually get in. But what I'm going to show you from a driver's perspective is whether or not, so we know that the market's gone up, but do we think they're about to take off? That's really the key. Now, I just asked you guys the question before, and pretty much every single one of you said, yes, you think it's going to take off. But let me give you some facts behind how to actually do that. So that is market drivers. These are the things that move the market, and this is the causation. What makes people make those decisions, okay? So how are they used? They're used to predict the future. The problem with these is it's a little bit of a black art, okay? There's no one single source that you need to go to. As a matter of fact, I go to over 200 sources to get the information to actually put this presentation together. It's actually quite an effort to actually do this. But once you actually get a handle on that, then it is like rocket fuel to actually understand how you predict the market. There are 16 drivers that actually go into this, and they come into 4 categories. There are government incentives. So government incentives include major infrastructure projects. So that's roads and tunnels and schools and trains and hospitals and all those sorts of things. Then there's cash incentives and bonuses. So that is the government printing cash to motivate people in a temporary fashion to actually do something. Then you've got supply and demand are broken down into building approvals, building commencements, and building completions. Then you've got the construction industry health itself. Then you've got finance approvals, whether they be first home owners, owner occupiers, and investors. Then we've got population growth, births, deaths, and marriages. Intrastate, that is people moving from the city to the country, people moving from the country to the city. And interstate, people moving from one state to another state. Then we've got international migration. And then we've got purchasing power. So this is the ability for us to actually spend and actually buy. Okay, so we've got unemployment rates. If you don't have a job, you've got no money to spend, so you can't buy anything. Interest rates, that is going to determine, how much we're going to pay every single month, but it's also going to determine our borrowing capacity. Household income and consumption. Have we got surplus and spare money that actually go into this? And then fiscal policy. So fiscal policy are 2 government entities, the RBA, Reserve Bank of Australia, and APRA, the Australian Prudential Regulatory Authority. Both of these have a thing called forward projections, where they are basically telling the market in advance what they think the market's going to do, with the whole idea of carrot and stick to go, well, I think it's going to go there, and if you behave, I won't ratchet you with an interest rate hike. Okay, but if you don't behave, then I'm going to. So they use that forward projection to send the sentiment to the market to slow down or speed up or otherwise. Now the RBA do it at a very rudimentary level. If they change an interest rate, it impacts the entire economy. Okay, so manufacturing, households, farming, all those sorts of things. If an interest rate goes up, everyone's impacted. APRA is more like a fine tooth, razor blade, where they can say, look, just for property investors, we want to make the changes to this particular rule, or just to owner occupiers, we want to make this change to this rule. So we have the 2 of those that need to work in cohesion together. Now, if you want to get really, really, really good at this game, and you want to have a crystal ball, and a little bit like my crystal ball here, what you're going to do is you're going to start to use the market drivers to predict where the market is going. And then in 6 months' time, you're going to use the market indicators to tell you whether or not you were right. Okay. Now, if you start to do that, whether you're right or wrong doesn't really matter. You're going to learn something from that particular process. And when you do learn something, then the next time you're going to get better at your prediction. And eventually you're going to hone your skills and become a master, like a Jedi in this particular one. So now, because this is a little bit of a black art, I simplify the process to make it really easy for you guys to understand. So the concept is called a headwind and a tailwind. So a tailwind, imagine you are walking down the street and the wind is at your back and it's actually pushing you in the back. It actually pushes you down the street. It actually helps you to get where you're wanting to go. Okay. A headwind is opposite. The headwind is the wind in your face, making it very hard to walk down the street, and it's providing resistance to actually go there. Then we've clearly got neutral, where there's no wind happening at all. And then you've got location specific, which might be where in one area, e.g. people moving out of one city, that is going to be a headwind, but they have to go to another city. So where they are being received might be a tailwind. So that is a location specific type thing. So when we start to do all this, then what I do is I map it out. And this is my predictions that I've gone publicly on record for the last while to kind of show where the market is going. You can actually see where we've actually struggled and where we're actually starting to go. And you can see that I've been predicting that we've been coming into this market uplift, which we've just had. So the question to you guys is, where do we think we're going? Okay, so I'm going to go through each of these different drivers. Now, I'm not going to go through all 16 because time will not permit, but I'm going to go through enough of them, and you can see the ones on the screen that I'm actually going to go into just to give you some insights. And I'm going to get you guys to tell me, is it a headwind or tailwind, before I actually reveal what I think it is in each instance. Okay, so let's look at government incentives and drivers. Okay. Now, we touched on this before. Okay, federal, state, and local governments are spending money out the wazoo. We're talking about, I guess, the media is saying that the government is overspending in this particular instance, but they're doing it in a whole bunch of ways. So look here, this is, so we are fundamentally right here on this graph, and there is more spending to come. We are almost going to be doubling our spending in the next 2 years or so on major infrastructure projects. So major infrastructure projects are roads and tunnels and trains and hospitals and all those sorts of things. Now, the reason for that is that creates jobs. Now, when it creates jobs, the people with those jobs then spend money in that local community, which means that the local businesses then start to benefit from that, and they can start to employ people, which then means those people start spending money in the local economy. And so what then starts to happen is people start to migrate to the area so they can live close to work. Okay, it is activating the area. Okay, so it is a very deliberate ploy. It's called trickle-down economics. And when you understand where the money is being spent, that is where the people are about to go. Okay, it's a really, really big clue to actually understanding where the demand is about to happen. Okay, now, then we've got federal and state government incentives. Now, there's a whole bunch of these that we're going to dive into deeper tomorrow. So I'm going to skim on these at the moment. So the home guarantee scheme, okay, so this is, I guess, government guaranteeing a 5% deposit so that you can actually get into your property. This is creating a supply, I guess, so people can get into the market much, much quicker. So it's creating people being able to buy our properties. There's the family home guarantee. So then they actually drop that down to a 2% deposit in some particular instances. Then we've got first home buyers guarantees. Then we've got the help to buy. So the government actually becoming effectively a joint venture partner with you. And then we've got the first home super saver scheme. So all of those incentives, and you can see that all of those are active at this particular moment. Then we've got enabling infrastructure. So enabling infrastructure is giant amounts of cash being spent on areas. And you can see some of those with $2 billion in them, for example. that are unlocking opportunity for, I guess, infill development. So putting things like sewer and stormwater and road networks and all of those sorts of things in there so that when the developer gets there, they don't have to drag those services all the way down the road. Okay. So you can see the majority of states have spent massive, massive money in this particular area. Okay. Now we've then got faster approval and planning reforms. So this is, I guess, stuff that we'll dive into super deep tomorrow, but this is cutting all the red tape and actually getting the opportunities to the floor straight away. So they're spending huge amounts of money on internal reform to actually change the planning rules, because that actually takes quite a bit to actually do. And they're incentivizing, I guess, all the state governments to actually do that. So the federal government is spending $3 billion to incentivize the states to do exactly this. And they only get the money if they execute on the supply. So it doesn't matter if they make a change. If nobody executes on that change and nobody builds the stock, they don't get the cash. So the federal government have been very clever to say, you'll get the money in 2 or 3 years' time when you prove that your changes and reforms have actually gone into place. Okay. Then you've got a whole bunch of things from, I guess, an affordability levers perspective. So there's density grants and, I guess, pre-sales finance guarantees to actually get stock actually moving, to get projects actually underway. So all of that big, big, big money and big incentives all the way around the grounds, okay? Then we've got the cash incentives. So this is, I guess, the government giving short-term cash to people to make them, I guess, want to buy our stock and being able to afford that. So pretty much every state government has done something with regards to first homeowners grants to actually help them to get onto the market in the first place. And there's not enough to fit on a single page, so we're going over to the next page. Then there's also stamp duty incentives. So from a stamp duties incentives, again, almost every single state have got some form of stamp duty incentive or compensation scheme that are actually coming, depending upon if you're, I guess, a first home buyer or just buying your principal place of residence. And all of those are sitting around the grounds. And then we've then got what is called a shared equity investment. So this is where the government then actually takes, I guess, a share position in your deal. So they will basically become your joint venture partner. So there's a number of states, I guess, Queensland, South Australia, and WA that have one of these incentives where you can get in with as little as a 2% deposit, and the government will then, I guess, become a shareholder anywhere up to 30% of your property, where you don't have to fund the whole deal. So, for example, if it's $1 million loan, government's going to take a 30% share. That means you only have to come up with $700,000 from your borrowing capacity. Okay, simple math. Okay, some states not actually doing that. Now, when we look around the ground, we've got a couple of these. So from a major infrastructure projects perspective, okay, from a major infrastructure projects, do we think that is a headwind or a tailwind? Give me, so this is the first line item, headwind or tailwind, folks? Everyone, pretty much everyone, Sharon, Roy, Tim, Rodney, Chris, Andrea, pretty much all saying tailwind. This is absolutely the wind behind our back. Now, the government incentives and cash bonuses, do you think that they are printing cash for people to buy our stock? Is that a headwind or a tailwind, folks? Absolutely, tailwind, tailwind, tailwind. So when we start to look at all of this, we can see that in this particular area, this is a green light for us to say those things are moving in our direction. That is going to be a great outcome for us, okay? Now, next up, let's look at population growth. Now, the next slide is quite a busy slide, so I'm going to go through line by line to try and actually help you out, okay? So we have state by state, we've got births, we've got deaths, we've got marriages sitting here. So we can see down the bottom is probably the net that we're actually looking at. So we've got a lot of births, nowhere near as many deaths. So our birth rate has actually gone up relatively well. We've got more people actually getting married. So that's the likelihood of more kids actually coming. Then we've got intrastate, so country to the city and city to the country. And you can see that they are relatively neutral here. There's a slight difference in those, but not a huge amount. Then we've got net interstate migration. This is people leaving the state. Look at how many people are leaving New South Wales. How many people are moving into Queensland, for example, okay? When we start to look at these things, where is... I think I've got my stats wrong on that particular page, on that particular one. My humble apologies. But when we actually start to look at that, then we've got net international migration. But in whole, population going up 420,000 per year. Now, when we try to graph all of that out in a very, very simplistic fashion, okay, then we can actually start to see state by state where the population growth is coming from and where it's actually going to. So we can see New South Wales, for example, a bucket load of international migration is actually coming in. Victoria, a bucket load of international migration. We've got a lot of births, deaths, and marriages, okay, but look at how many people are leaving Sydney and leaving Melbourne, and they're landing in Brisbane and Perth, okay? So when we look at location specific, this would be a headwind for Sydney because that's people leaving, but that would be a tailwind for Brisbane, for example, okay? So when we start to look at that, there's a lot of people. Now, we can see small amounts leaving Adelaide, small amounts leaving Hobart, leaving Darwin, leaving Canberra. Pretty much the big winner is Brisbane and Perth from a location perspective. Now, there's a really simple reason for that, okay? Over and above, I guess, the cost of things, but the cost is a lot to do with it. They can sell down in an expensive area and go get a better lifestyle in the other locations. Better lifestyle because it's cheaper to live, better lifestyle because the weather is a little bit better, and both Perth and Brisbane create those lifestyle opportunities. That is causing a huge amount of growth happening in, capital growth actually happening in those areas, just because there's a lot of demand actually moving there. But you can see Sydney and Melbourne are getting the bulk of population. Then Brisbane and Perth are getting the next, and Adelaide coming behind. So they're the guys that are actually going next, okay? So when we look at births, deaths, and marriages, do we think this is largely neutral? Do we think this is largely, I guess, a tailwind? Where do we actually sit this one? A lot of people are saying tailwind. A lot of people are saying neutral. Look, this is a, I would say it's neutral to tailwind. It's kind of on the cusp in this particular instance is kind of my pick on that. Intrastate, I should say. So that is people from the city to the country, country to the city. Do we think that is largely headwind, tailwind, or neutral? A lot of people giving mixed answers there. So I'm going to pick that one as largely neutral. Interstate, so that is people leaving one state and moving to another. Okay, now we just saw, I guess, what's happening in Sydney and Melbourne. That's very, very, very much location specific. But across the board, this one I think will be a very, very, very clear winner. What do we think with international migration? Right, international migration. Absolutely. Tailwind, tailwind. Jenny says tailwind. Stuart says, Sabitha, Tim, Chris, Moklis, Sunil, everyone is saying tailwind. Okay, so when we map this out, now, if you said a tailwind for births, deaths, and marriages, I would be happy with that as well. But it's kind of not a massive, I guess, differential between them. But fundamentally, we've got a lot of green lights, two locations, that would be Sydney and Melbourne, that have got one red light so far. Okay, let's take a look at supply and demand next. Okay, lots of things go into supply and demand. We've got building approvals, commencements, completions, the construction health industry, and then we've actually got our finance approvals as well. So let's take a look at this. This is our historical, I guess, graph of building commencements and building completions. So commencements is in blue, and completions is in orange, and you'll see that there's obviously a lag. When I commence it, it's going to take time to complete it. So you're going to see, I guess, the completion timelines are a little bit lagging. But you can see here that our 60,000 that we need per quarter for the next 20 consecutive quarters, and we're already 6 quarters behind, we have never met. And at the moment, we are just shy of, we're just over 40 odd thousand completions, I should say, per quarter. We are well short of our target at the moment, okay? So this line here, this is our target. You can see the blue line has punctured this before. This was a commencement. This happened, I guess, when all the building boosts happened, and but you also know that a whole bunch of builders went broke at that point in time, and a whole bunch of projects blew out from a timeline perspective. So the completions are scattering out here, even though I guess the commencements happened over here. And then you saw a massive drop in commencements actually occurred. Now we can just see it starting to turn around, and it's going in the right direction, but is it anywhere near enough at the moment, folks? That's really the question that you've got to actually ask yourself. So from a opportunity perspective, so we're definitely not there, but from an opportunity perspective, are you seeing this as a headwind or a tailwind at the moment? That's the question for you, okay? And it's going to take a while to actually get ourselves there. Now let's look at the detail of the numbers, okay? So remembering we're only a year and a half in since the Housing Accord was actually announced. And while we're a year and a half in, the statistics only come out quarterly. So we've only got Q1 of the second year, okay? So this isn't a complete answer. But in year one, we had a 65,000 shortfall in what we're expecting out of that. And in quarter one so far, we've got a $14,000 $14,000 shortfall. So when we actually start to put that together and we go, well, if I project that out in order to complete this, so we had our original allocation, what we've actually completed so far, what we've got remaining to complete, this is what we now need in each individual state. So we need 244,000 per annum now. So the amount of dwellings that we need is going up on a per quarter basis. So it was an average of 60, but now it's an average of 64-ish in order to actually get us there. And the more that we start to lag behind, the bigger that gap is actually going to get. So that creates more and more and more, I guess, demand pressure on what we're actually needing here. So from a demand pressure perspective, that is, we're not measuring how many completions. What we're measuring is the demand on the lack of supply that's actually there, okay? So when we actually start to look at that, are we seeing that as a headwind or a tailwind for us with regards to the demand is building and building and building, right? Absolutely. Tailwind, tailwind, tailwind. Absolutely. Jenny says it. Lisa says it. Atul says it. Lindy says it. Maggie says it. Connie says it. I'm assuming that's the Connie that just won. Well done. So absolutely a positive outcome here. Now, the next thing, now this is, and I probably should have labeled this particular slide a little bit better. Rawlins is a company that actually measures the cost of construction. So this is telling us, we all know that cost of construction is going up everywhere, okay? But when we actually look at the cost of construction, we're predicting that the cost of construction is still going to go up, and that's going to change slightly depending upon the state as to how much that's actually going to be. But pretty much across the board, the cost of construction is actually going up, okay? And that's not a function of, I guess, the materials anymore. It was materials that were actually happening, I guess, because of the infrastructure lag. There was, the supply chain lag, I should say, with COVID. We've now overcome that, but now it's a labor shortage issue because the amount of construction we need means that the tradies can actually charge more for actually doing this. Now, this is going to sound crazy, but the tradies charging more means that less tradies are going to want to leave the industry. As a matter of fact, there's a whole bunch of government incentives where I guess new tradies, mature age tradies are being given $10,000 bonuses to actually enter the market to actually become tradies. So we're actually trying to bolster our builders and tradies supply chain in order to not offset the cost of construction, but actually bring more tradies into the market. Okay. Now, when we then look at finance approvals, okay, so now investors, the data was missing for the previous years, but investors are this green line here, and first home buyers are this blue line here, and owner occupiers are here. So predominantly it's owner occupiers that are actually getting into the market. Investors are equally getting into the market. They're trying to incentivize the first home buyers to actually get in there. They're trying to de-incentivize the investors. They want to get us out of the market so that the owner occupiers and the first homeowners can actually get into the market. So when we start to look at that, but this is the actual finance approvals that are actually coming through. So despite the fact that interest rates are going up across the board, predominantly there are more and more loans still being written. Okay, so that's giving us, I guess a whole bunch of incentives actually going into that. So do we see that as a tailwind or a headwind? That's the question for you guys. Okay, so tailwind. So everybody's seeing that funding is still coming through, whilst we still have some challenges in that market. Everything is still currently still tracking through. So when we actually look at this, you guys said building approvals, that massive window, we're seeing that now turn around. You all said that was a tailwind before. The building commencements, so that is equally starting to lift, but the lack of that at the moment is creating more pent-up demand. That's another tailwind. And then when we have a look at our finance approvals, that is another tailwind. So we're seeing a hell of a lot of green lights sitting in here at the moment, at this point in time. Okay. So are we all getting plenty from this so far, folks? Tim says yes. Sandra says yes. Ben says Nat. Sue, Hugh, and a whole bunch. Thank you, Navid. Thumbs up. Thank you. Great work. Thank you, folks. Really appreciate it. Okay. Lucky last. Let's look at purchasing power. Now, in order to go into purchasing power, not an economist, but I just want to give you a tiny bit of understanding how the market actually works. Okay. When we start to talk about inflation rates and the impact of inflation on us, this is, I guess, something that comes from the Reserve Bank of Australia, okay? And this is basically what they're trying to tell us is they are aiming for an inflation rate target, which is this yellow line. They want that to be somewhere between 2 to 3%. They want our economy to grow at a pace that is sustainable. Now, if our economy grows, then we have more money, we have more surplus cash, we can actually buy things. And as the cost of things go up, we can actually afford to actually do that, okay? If inflation gets too high, okay, then we start to get unemployment. Unemployment then means that we can't, so businesses can't afford to run, they shut down, and people get laid off. So you start to get huge amounts of unemployment. So people can't, I guess, function when there's very, very high inflation. And equally, if we go the other way, then we've got lots of people with jobs and they start spending money really fast. And so that starts to shoot the economy back up, and we go the other way. So sorry, I got that back to front. So what we're trying to do is this nice, steady, even line, okay? Now, the RBA introduced that concept of that 2 to 3% market around about 1992. That was because we had all the way back here, we had two recessions that were actually happening, and so the interest rates were ridiculous. Sorry, inflation and interest rates were ridiculous. I don't know if you guys remember, but the interest rates of 17, 18, and 19%, that was when I bought my first property way back then. So that, I guess since then, what they've said is we need to control fiscally the market. And you can see this purple window here is them mapping that 2 to 3% range over time. You can see they've done a pretty good job of actually doing that, with the exception of down here, which was, I guess, when we were actually struggling. I said before, we actually had some economic pressures on us at the moment, and they dropped interest rates down. If you remember, the cash rate went to almost zero at one point. That was in this period here. Then we had this funny thing called COVID, and that caused supply chains around the world to, I guess, collapse, which then meant that the cost of everything went up because the demand was still there, but we couldn't actually supply. And that caused a whole bunch of inflation. And so they brought it back down, and it bounced and has actually gone back up again. And the reason why it's gone back up is clearly because of all the government spending that's actually happening at the moment. Okay, so what they're trying to do is they're trying to manage that back into that 2 to 3% range. So when we look at the next round of stats, understand that they're close to that range, but they're not out of the woods. They're just trying to get it to land softly in that range. So they're not wanting to do massive rate cuts, but they're wanting to do a soft landing into that, okay? So when we look at our interest rates, we clearly just had, I guess, an interest rate hike with the cash rate going up to 3.85%. But previously, we had, I guess, a period before where we actually had 9 consecutive rate cuts to try and bring us down and actually speed up the economy. Then they slowed it down, and you've seen the bounce. What they're trying to do is get that bounce to then land back into the range. Okay. Now, one of the things that they look at in that is the unemployment rate. Now, the unemployment rate, you can see, is just around that 4% mark. Now, this again is the range that they want, I guess, from the unemployment rate. So unemployment is almost exactly where they actually want it to be. So they're not wanting to make rapid changes to anything at the moment in the economy. They want it to kind of find its own equilibrium. Okay. Now, when it finds its own equilibrium, that's when we're going to get that long-term stable growth. Now, one of the things that tells them whether or not they can do, I guess, interest rate hikes and the like, is this thing here, the household income and consumption. And you can see the blue line here is disposable income, and the orange line is actual consumption. So they can see we've actually got some spare cash. And so if they bring some interest rate rises to us, they can see that we can afford it for a little period of time, but we can't afford it for long. So they don't want to break us. So again, they're going to try and bring it in for a soft landing where humanly possible. But they do know that they've got some room to move if they need to. So that's why we just had that rate hike, I guess, only a few days ago. But then what the RBA does is a thing called a forward projection. So the forward projection is them saying, look, if you don't behave, we've got a great big stick, okay? And we're happy to use a great big stick, but this is how we want you to behave, okay? And if you do behave correctly, then we're not going to wield the stick. We're going to be really nice, okay? So what they've said is inflation has fallen substantially since the peak, but it's picked up materially in the second half of 2025. We all know that's because of all the government spending that we just saw in that first part. Board is closely monitoring and judges that some of the increased inflation reflects greater capacity pressures. As a result, board considers that inflation is likely to remain above target for some time. Okay, so they recognize that it's going to be there, but they also recognize that they don't want it to have that big crack. Okay, that big drop. Okay, now I said before the RBA is, I guess, the impacts the entire economy. And then APRA, the Australian Prudential Regulatory Authority, they impact individual markets. So in this instance, they have just come out with a change, okay? And it actually became effective on the 1st of February. And what they've said is they want to limit the number of high debt to home loan ratio, okay? So to greater than or less than 6% of income, okay? So, and they want no more than 20% of their lending to actually breach that. So they don't want investors to actually, I guess, keep cranking and buying more and more properties. So they're de-incentivizing the investors, okay? They're trying really, really hard to de-incentivize the investors. But I'm going to measure that with, at this point in time, whilst they've put that measure in place, most banks are nowhere near that 20% cap at the moment, okay? What they're trying to do is to make sure that they make the banks behave and not take on too many investment loans. They're wanting them to take on more first homeowners and more owner occupiers, okay? So if you are an investor and you have been a long-term investor, you'll still be able to get loans in the next little while, but it's going to start to become progressively harder and harder as the thresholds start to tighten up. But all of that said, it's not taken effect yet because the most banks aren't at that 20% limit. So it's kind of trying to slow you down, okay? Okay, that said, CanStar, I guess, goes and talks to all the economists at every single bank out there, and the economists put a hell of a lot more assessment into it than what I have here. And when we have a look, the Commonwealth Bank says that it's going to remain steady. Westpac says it's also going to remain steady. ANZ says it's going to remain steady all the way through to the end of 2026. So 3 out of the 4 banks are saying no rate changes for the rest of the year. And the NAB is the only one that says that there might be a 25 basis points adjustment in May, okay? So when we look at all of that, okay, there's a lot that has actually gone into that, but all of it is trying to give us a safe landing, okay? So they're not trying to break us, but they're trying to make sure that we don't get out of hand. They're just trying to give us a nice graduated change to bring us back into that 2 to 3% mark. So when we look at that, folks, from a unemployment rate, is that a headwind, a tailwind, or is that neutral? Vishal says neutral. Charles says tailwind. Jenny says neutral. Ian says neutral. Cynthia says neutral. AJ says tailwind. Catherine, neutral. I'm going to say that's neutral, folks. It is pretty much exactly where they want it to be. They've brought it back into, I guess, the range where they want it to be, and they don't really want it to snap out of that, okay? Interest rates. Now, right now, you can see here, I've put a headwind right now because we have just had that rate hike, but moving forward over the next 6 months to 12 months, looking at what all the banks are predicting, do we think that's going to be headwind, tailwind, or neutral, okay? So we've got some mixed answers here, but the majority of you are saying neutral, okay? Now, what about the RBA forward projections at the moment, okay? So RBA is saying, hey, we're going to keep an eye on things, but we're going to look at the numbers, okay? And equally, APRA, what do we think they're doing at the moment, okay? Can see some mixed results with what everyone's saying. Some people are saying headwind, some people are saying tailwind, but I'm going to say pretty much across the board, neutral. They don't want to break the system. Right now, they can see that it's going to come in for a safe landing. They want it to come in for a safe landing, and they don't want to pull the levers too hard at this point in time to get it to shoot through the range too hard, because they don't want it to overshoot the mark, okay? So at this moment in time, I don't see that we're going to have huge amounts of changes here. So what we're looking at here now is, as we go down our columns, I can see 1, 2, depending upon where I am, 3, 4, 5, 6, 7 tailwinds. If I'm in somewhere like Brisbane or Perth, and if I'm in Sydney or Melbourne, that would be 6 tailwinds and 1 headwind, okay? But predominantly, where do we think the market's going, folks? Where do we think? Do we think it's going up? Do we think it's going down? Do we think it's going sideways? Where do we think it's going? So we can see right now this interest rate change that's actually happened here, okay? So the unemployment rates and the interest rates were challenging before, but now that we've got it in control, that is, you can see all the media is creating so much hype about this but we can also see the numbers are telling us slow and steady, okay? So you're going to see the market start to pause at the moment, which is your opportunity to pounce. I cannot stress that enough. It's your opportunity to pounce because the market is going to stall for a little bit before all of those tailwinds then kick in again, especially when people start to understand the development potential that's actually sitting behind their properties, okay? So in summary, this is kind of the take up, the wrap up from all of this. Population growth fueled by international migration is a major driver of demand, okay? We've got a massive challenge with supply and demand, okay? But supply specifically, economic circumstances prior to COVID, COVID itself, the building bonus, and building cost escalations, all of those caused a massive lack of supply, okay? Now our recent rate rise has caused the market to stabilize, and it's caused everybody to pause, which I think is going to create some great buying opportunities. But we can also see massive federal and state incentives for the supply side. So that is what we need to create in order for us to create stock. And they're also creating massive demand and on demand side. So they're giving away lots of cash for people to take the stock off our hands as quickly as we can create it. Okay. So seeing that already, the market has shown some strong growth, but there's still plenty of room for significantly more growth to actually occur. Would you guys agree with that? Yes or no? Absolutely. Everybody is saying yes. So far, nobody said no. Okay. Rob says yes, however. Okay. There's always a however. I'm trying to give you an entire economy in literally just a couple of hours. It's very hard to actually go all the way. So where do I think the market's going? Well, before I tell you where I think the market's going, this is what the people that are way smarter than me are saying. So KPMG have forecast across the board that we have got, capital growth going to happen pretty much everywhere across the board. Now we can see Perth is, from a housing perspective, is going to get upwards of 13% this year, and then slowing down to 5%. And units and apartments are going to be 12% down to 4%. All the way down to next is Brisbane. Then we've got Sydney and Melbourne, very, very similar in 6% and 7%. But you can see the numbers all the way around the board, folks. All of the economists that are putting a lot more effort into the analysis than me are all predicting what you have just seen out of those 16 drivers. So hopefully you guys got plenty from that 16 drivers. So in short, folks, now is the time to take massive action, okay? There's huge buying opportunities right now where the market is about to pause before it actually takes off. So you're going to get your development profits as well as market uplifts, okay? So you're going to effectively be able to double down on your profits. You won't double your profit, but you'll get a double whammy out of your deals, okay? Now, in doing that, because of the rapid change that is happening in, the planning rules at the moment, we're going to go deep dive into that tomorrow. But because of that rapid change, there are so many people who were previously thinking they're sitting on a single house that now has development uplift, and they don't realize that development uplift potential, that they're still pricing it based on the old single dwelling prices, okay? So yes, the market has lifted, but they are under assessing their current rate. Now that opportunity won't sit there for very, very long, okay? Now, when I look at the market, we normally have market cycles that go up and down like this, but because we had this funny thing called COVID, we never had that full retraction, and we had a false market caused by a false recession and then an artificial boom. So our market kind of did this flatline thing like this, okay? Now, from that period to this baseline here, about 12 months before the market actually started to take off, right now, we're out of the post-COVID, artificialness, and we're back to true fundamentals, okay? And because we're back to true fundamentals, this growth period here, I think, is 2 to 3 years long, okay? Now, I've been predicting this, and I've been showing pretty much this exact same graph for the last 3 years, and I've been tracking where we're going. I think we're about here. So we're actually seeing the market actually go up, but we can see that there's a long way to go. And I think that I'm going to say, at least 12 to 18 months before we get near the top. We're going to have to pay a lot closer attention in that 12-month period. But we've got a small window of opportunity where we get the double whammy. And that's the key to what I'm trying to emphasize to you. When we spoke at the start of today about taking action, if you are not prepared to take action now, I do not know when you're going to get a better opportunity ever. I've never seen a setup as good as this in my entire life. Okay. So my big question to you is this helpful? You guys getting plenty from this? Yes or no?
Hey folks, there you have it. That's where I think the market's going right now, and the 16 different drivers that are moving the market, and why all that government spending that you're seeing at the moment is causing inflation, but that government spending is actually activating the ability for you to actually go and do deals. So we've got government giving us incentives to create stock, and we've got government giving buyers the incentive to buy stock, so that the culmination of that means we've got a perfect storm of opportunity with regards to currently a huge demand. We currently have a lack of supply. We're enabling the fast track approval processes to actually get everything there as quick as humanly possible. We're activating buyers to actually take it off our hands as soon as we've actually done it. There is nothing stopping you from wanting to get into being a small scale developer at the moment. As I've said before, this is the greatest time in the last 50 years that I've seen all three levels of government, so federal government, state government, local government, all of them are moving in the exact same direction, and that is to put more housing stock out there. And they need an army of small scale developers to actually help them do that. So if you've been motivated, inspired in order to do that, then let me give you some insights in how you can actually get involved and start to learn the process. So firstly, we run meetups all the way around the country. We run them in Brisbane, Sydney, Melbourne, and Adelaide. We run 55 events a year, and Perth is just about to go live as well. So that is 55 events per year, where we have industry experts, so town planners, civil engineers, architects, property lawyers, accountants, all the different people that you're going to need on your property journey, giving you insights into your common issues, challenges, and problems that you have on your journey. We also have members of our community sharing with you real deals, so you can get to see the good, the bad, and the ugly of the project, and learn from the successes of others that have gone before you. All of that should be motivation and inspiring and supporting you and creating a community of like-minded people sitting all around you, because you are the sum of the 5 people you hang around. You want to hang around with people who start to do property development. So do that. Then if you haven't done any education or mentoring and you're thinking you actually want to go through that process, then the 7-step formula to financial freedom is a free course that we actually offer. That's just going to give you the insights into what it would actually look like to come inside our 12-month education and mentoring program, to give you the insights into some of the things that we're actually teaching you in how to set yourself up for success, because there's a framework that actually sits behind this. And when you do, if you finally decide that you actually want to have some formal education, then you've got I guess myself and 4 other mentors, 2 coaches, and a team of 23 people sitting behind you if you decide that you want to go inside the Property Development Formula Education and Mentoring Program. All of that, folks, is opportunities for you to get involved, learn the process, start small, step up, and scale your property development business. Hope you got plenty out of that today. That's over the horizon, and I cannot wait to see you at an upcoming meetup. Till then, folks, I can say bye for now. Bye.